stock price today equals the dividend in one period at its growth rate, divided by the required rate of return minus that growth rate. You get that, we're good. But real world application. Let's say you've got a factory that makes toilet seat covers. And that factory puts off $1 million in net profit per year. And you want to sell that factory. How do you value how much that is? One back of the envelope way, like let's say you want to buy a business and you want to know, well, how much is that really worth? Is you figure out your dividend, which we're going to say is $1 million a year because that's your net profits. You have a required rate of return of, I'm just going to say 17%. And you have a growth rate, 5%. So when you do the math there, that means you would pay $8.33 million for the factory that makes toilet seat covers. Now here's just a little bit of interesting part. We can figure out different required rates of return, but let's try a different one just to show you how the numbers would change real quick. Let's say you lowered your expectations. And your required rate of return is now only 12%. So 1 divided by, what was that, 0.07? That gets you 14.3 million. Is everyone comfortable with why this number is higher?
Wait,
now
what?
that your required rate of return is lower?
Explain.
Basically what's happening is, you're saying that this perpetuity, how much are you willing to pay for these future assets coming in? If you had a really high required rate of return, you're going to pay less because you want to earn more. If you have a lower required rate of return, you're okay not making as much money, then you're willing to pay a higher price for it. And this is where, and mind you, this is all just back of the envelope type calculations for valuing something. When you're really valuing a company, there's a lot more. But this kind of gives you a rough guide of how much would you pay for that. And if someone's offering a company for sale, like you can look on bizbuy.com, bizbuysell.com, and you can see people are selling like a local franchise at TGI Fridays, and they'll tell you, here's our net cash flows per year, and here's how much I want for this company. And we expect cash flows to grow at this amount, whatever, and they don't tell you this number. And that way you can figure out, what is that real required rate of return? What return am I really getting? So it's just a real world application for this formula, besides the obvious one of stock valuation.
And so as an investor, you would determine for yourself what your own required
Yeah,
rate
you're
of
just
return
making it up.
is.
Right. I mean, there's a lot more in valuing a company, but this is a way in less than like 5 seconds to see, okay, let's say I didn't give you this, right? Let's say I just gave you a number, and I said you're going to get $1 million in cash flow a year for the TGI Fridays over by the Loft Apartments. And for that, I want $20 million. Now you're going to get $1 million a year in perpetuity growing at 5%, so what return is that for you? And that's where you can do some algebra and figure out, oh, that's a 6% required rate of return. Well, if your cost of capital to borrow is 8%, bad deal. Yeah, you wouldn't do it. You'd be like, no, I'll pay a lot less than this. And that's this is really rough and ready type stuff. You do a lot more work, obviously, but this is a way to see what's the required rate of return given this price, or what's the price given a certain required rate of return. All right, let's move on to CAPM.